What a way to start.
What a way to start.
It's all about the entertainment.
Begin with a bang.
Yes. So we're all here now, I think. And we're online.
Okay. Good afternoon and welcome to the webinar. This is ATB Partners webinar number 16 in the series. My name is Anna Perdrio. I'm the founder of Speaking Excellence and your host for today's very exciting webinar. We'll be getting started in just a moment. A couple of instructions for you, for those who are jumping online here. Just pop in. You can say hello in the chat box. Feel free to let us know where you're logging in from today. And also just a reminder that we love interaction. So we have a really fascinating speaker today and we love engagement. We love your questions and your interaction. So please feel free to ask questions at any time and use the Q&A box for that, which is one of the icons at the bottom of the screen. Okay, so feel free to do that. Now, I would love to introduce our amazing team today. Of course, we have the team from ATB Partners. And first of all, we have Jim Vass. Jim is really passionate. He is a director of ATB Partners for 26 years, a director of ATB Wealth for 6 years. He has multiple degrees in commerce, the Uni of Newcastle. He's the treasurer of the Cumberland Business Chamber. He's
Actually, that was a while ago. I'm not a treasurer any longer.
Okay, well, he once was, and he's got such a long list, it's hard to keep track, I'm sure. I'm sure, Jim. Financial controller and accountant, award winner, accounting practice of the year, and he is multilingual English and Greek. Hello, Jim.
Thank you for the lovely introduction, Anna.
My pleasure. And we also have another ATB partner. It's Michael Mekatarian, who's also a director. He's an highly experienced chartered accountant and fellow CPA. Sits on the board of several companies, and he is the past president of the Parramatta Chamber of Commerce. And together, of course, Michael, Jim, and Paul are the directors of the Parramatta-based accounting firm ATB Partners, which was, of course, founded over 25 years ago. They're highly sought after in their field. They are thought leaders, and that's why they're bringing you these amazing webinars every week or every couple of weeks. Michael is also a Business New South Wales councillor, sits on their Economic Planning Committee, and he's the Vice President of the Regional Advisory Committee for the Western Sydney. And he's an amazing visionary and all-round great guy. Hello, Michael.
Hello, Anna. Thank you very much.
Thank you.
Appreciate it. Hello, Jim and Graeme. Hope you guys are good.
Hello there.
Yeah.
Yes, and Graeme Beattie, who we will be hearing from today as the feature presenter. We will be introduced to Graeme very soon. Graeme is a partner at Worrells Solvency and Forensic Accountants in Western Sydney. But for now, we're going to hear from Michael, who's taking us through some very important business. Michael.
Okay, I'm just going to try and share my screen, Anna. So just give me a minute to do that. And while I'm doing that, I just want to let Jim know that as much as I tried to live stream this on Facebook, it gave me an error 404.
That's what I was getting as well.
Yeah, you're getting the same error, were you?
Oh.
Well, let me just first of all share my screen and
Michael's about to take us through the 5-step process.
I am. So I'm hoping now you can see.
We can. Early signs of
insolvency
is today's topic.
Okay, thank you very much. Thank you, Anna. And I'm sure we got a number of people on. I can't see the number of people on, but Anna, do you want to talk about them asking questions and how they should interact and all of that bookkeeping before I start? Or housekeeping, not bookkeeping.
Good point there, Michael. Yes, absolutely. Yeah, it's a welcome. Hello, Alexander, Bhavna, Darren, Laurie. We have a number of people online today. Thank you, welcome, and thank you for joining us. Just a point about, we love interaction and engagement. So if you'd like to interact, please do so. Please type your questions at any point in the webinar and type those in the Q&A box, which is at the bottom of the screen.
Yep, that's not the live chat.
Yes.
The reason we do that is because we actually keep the questions in the background, and it's stuff that we like to, you know, drill down on, make sure people have got the correct information. Thanks for that, Anna. Okay, look, early signs of insolvency, what you need to know, and Graeme will be talking a bit later along with Jim. As most people know, we, when you look at our website, and the people who do know us know that we ride motorbikes, and by the sounds of some of those names out there, some of those people have gone on rides themselves with us or with Jim or whatever. And we talk about taking control because those people who ride motorcycles know that if you don't have control, bad things happen. When you ride a motorbike, you need to have absolute control. And that's the key to riding a motorcycle. They're powerful beasts. There's nothing to protect you. They don't stand up by themselves. So over the years in ATB, we have a very large team of people. That was taken pre-COVID, and there's a couple more bodies in that team. So I'm hoping that, you know, maybe after Christmas we can all get together again and have another photo, update it all. But there's two businesses there. There's the chartered accountancy business, which, as you said, has been around, you know, 26 plus years, but it's also a wealth business. It's a financial planning business. Today, I'm gonna talk about how long we've been in business and bad ties and pants that come up past your navel. And there's a reason that I've got this shot here, because back in those days, Jim and I started this business out at Hurstville. Since those days, ties have changed, pants have changed. But also since those days, we've had a NASDAQ tech crisis, we've had a GFC, and now we've had a COVID crisis. We've been through a number of these ups and downs. There's some similarities in them that, you know, when things go bad, they go really bad. But we've been through it, and we do know that with careful planning and, as I said, taking control of your business and taking control of your life, you can actually get through it. And we still have some of the clients that we had back in those days. When we were a little bit younger, had more hair, didn't have goatee beards, and wore ties. And I will say, just one of the things we were talking about before we came live was, will the corporate tie come back?
Will the suit come back?
That's a big question. Will the suit come back? These are the questions. Things go well, things go bad. If you allow you and your business to be blown about the circumstances, you're most likely going to fail during the, you know, the tough times. If you take control, then you have much better opportunities. That's the key to this message. Now let's talk about success. And here's my definition of success, which is doing what you want, when you want, where you want, with whom you want, as much as you want. That's by Tony Robbins. And Jim and I, a couple of years ago, up near Jerry's, I think we just had breakfast, and we're going out riding our bikes. We enjoy doing that. We like getting out into the countryside. So how do we help people achieve their success? We've developed what we call a 5-step process. And I want to put this in with a lens on, if things are going really bad in your business, what do you do? And that's where I guess Graeme will be taken from, discussing some of the options that are available. So as you know, you start with understanding your purpose. We then go to the next step, which is assess if this thing's practical. Is it going to work? Are these achievable? Let's put that in context of what's happening right now with COVID. If you're taking a snapshot of your business, if you're looking at your financials, and I know Jim and Graeme are going to go a little bit deeper into this, so I'm not going to go too deep into it. What happens if it comes out that it's not practical? Like it's just not going to work? Things have changed. In some people's cases, it's much busier. In other people's cases, things are dramatically different. So what do you do there? Well, you've got to go and drill down and find out what you can do. We then talk about prioritizing certain tasks that you need to do. So, if things are not working, what do you need to do? What are the most important things you need to do right now to get back on track, take control? Next thing you've got to do is implement it. It's all very well saying, look, things are tough, I need to restructure, and not going to the next step, which is, dealing with the issues head on. Final step is measure and plan. And again, in terms of what, Graeme does and what, this is about is, insolvency. What happens if you're measuring and planning and it's not working the way you had hoped it worked? What are your options there? So that's how we look at things. And, we put that in context of having up-to-date figures, your numbers are up to date, et cetera, et cetera. And this is so vital at this point of time because as we're heading into JobKeeper Mark II, it's measured on the September Vass. Now, you don't want to leave that until sometime in January to lodge and, okay, I'm going to get a refund and I might not get fined and who cares, but, you might miss out on JobKeeper for 3 months if you're eligible. But what happens if you're not eligible and you didn't know? So you just can't let things drift. Again, take control. So Anna, that's it from me.
Yeah.
I'm going to, I guess, allow Jim to take control of the screen.
Just while he's doing that, Michael, so on that second point there, assess if it's practical, would you recommend that people really need to revisit that step in a post-COVID world?
I think they need to be continuously reviewing their business because, look, let's say you were running a gym 2 months ago. There was no business. Let's say you're running that gym now. What's happened? What are your numbers coming through? What are your costs of running a business in this world?
Well, what we really should do is actually get on with what we're all here to talk about. So would you mind introducing Graeme and then I'll start the slideshow.
Absolutely.
You'll take over, Jim? Good.
Yep.
Thank you, Jim. I will. Allow me to introduce Graeme Beattie. Graeme is a partner at Worrells Solvency and Forensic Accountants in Western Sydney. With more than 15 years experience in corporate insolvency, Graeme is highly regarded for his knowledge and practical expertise in the area of pre-insolvency, business turnarounds, and insolvency solutions. He's worked across a variety of industries from retail and wholesale, manufacturing, transport, agriculture, information technology, property development, professional services to registered clubs, and he has a strong reputation for being able to apply diverse solutions, business models and structures to businesses to enable them to move forward from financial distress. Thank you so much for joining us, Graeme.
Thanks, Anna, and thanks to Jim and Mike for the invitation today. I hope everyone can hear me clearly. If not, let me know.
Yes, we can.
So today, what the guys have asked me to come and talk about is the early warning signs of insolvency. And look, I think this definitely ties in with what Mike was saying there about riding the motorcycles and having absolute control. A big part of this is being aware of some of the indicators and those warning signs so that we can monitor our business as well and take the required action that's needed. So thank you, Jim. I just need to go through my usual disclaimer here, where all of what we're talking about today is just by way of general comment and is not actual formal advice. If you are looking for advice in this respect, be it general or specialist, you do need to approach the appropriate professionals, be it ATB Partners or ourselves, to help you through that situation. So first of all, we're going to look at what is insolvency. I'll get the boring definitions and the like out of the way first so that we can frame what's going to be discussed. So insolvency is expressed as the inability of a company or individual to pay debts as and when they fall due. Just an interesting point, there is no actual definition of insolvency in the Corporations Act. It is a term that is defined by what is solvent. So when we talk about insolvency, it is actually the other way around, where it defines solvency as a person who is solvent only, if and only if the person is able to pay all of its debts as and when they fall due. And then conversely, if you're insolvent, you can't pay those debts as and when they fall due.
So that definition's come around by case law. How's that come about?
Well, the definition is actually set out in the Corporations Act. It's the section there 95A, and it is really insolvency is the converse of what the definition is, if that makes sense.
Solvent. Okay, fair enough.
Yeah. So signs of insolvency is a slide, and we'll spend a little bit of time on this slide just to touch off on these points. But before I go into this, one of the considerations is when we're looking at whether a company or an individual is solvent or not, we're looking at two things. One is balance sheet solvency, and the other is cash flow. So the cash flow ties into that comment of being able to pay the liabilities as and when they fall due. So these are some indicators that, and I'm not going to go too much into case law or anything like that that's highly technical today, but these are the indicators that have been set out in the cases that have gone through the courts when we're looking at trying to determine solvency or insolvency for an insolvent trading claim that would be run by a liquidator. An insolvent trading claim is where we are looking historically at the conduct of a company to say what debts might a director be liable for in respect of trading when the company was insolvent. So that's one of the reasons why the solvency of a company is key, is because as a director, the client may be exposed to a personal action in relation to those debts.
So I suppose, again, to probably put it into my own words,
yeah, please.
Whilst the company may be insolvent, okay, there's a point of no return, I suppose, where typically a lot of people go into a company and trade through a company structure because they say, oh, it's got limited liability. The liability is going to actually stay with the company. What we're looking at here is we're actually looking at the point of no return, where if the director has actually ticked off a few of these things, or even one of these things, and it can actually be shown that the director's gone past the point of no return, so he can no longer rely on the company to shield him and his personal assets. He's actually now leaving himself wide open for the company's liabilities as well. Is that how the layman would interpret it?
Yeah, that's correct. I mean, one of the things to probably note is it doesn't mean the company can't return from being insolvent, but there is definitely the risk of, during that period, once the company has been determined to be insolvent, the director can be made personally liable for that debt that's incurred post that date of insolvency. Now, look, if you were to talk to any liquidator or insolvency lawyer, they will tell you that determining that date is one of the more difficult things that we do, because it is via a series of indicators, but that's where these signs of insolvency come in. So just to touch on a few of them, if we work through 1 through to 13 quickly, and as I said, I won't take too much time on them because we could talk all day just about a few of them. Something like continuing losses seems like it's a fairly self-explanatory piece. It doesn't necessarily mean that a company is insolvent, though, just because it's making losses. There could be sufficient working capital in order to prop up those losses during a period where it's not trading. But a point to note there is one of the key areas that we tend to report to ASIC about the failure of the company is that it does not have sufficient working capital. So it's one of those areas that tends to be common in most companies, that there's really just not enough capital in the entity to trade through a down period. Liquidity ratio below 1. Again, this is just an indicator where we look at the current assets and current liabilities of a business to say, is there enough in current assets at any given time? And these are probably accounting definitions that we could go in.
Layman terms, money in the bank, amounts owing from customers of a business to the business. That's basically your liquidity. And then current liabilities is how much the business owes in short term. So it's basically a matter of saying, well, how much does it owe its creditors? How much does it owe the tax office and stuff like that? So what we're saying is what's owed to the business has to be greater than what is owing by the business.
Correct. And that comes back into that.
Equal.
Yeah, exactly. It comes back into that whole comment in the definition of paying those liabilities as and when they fall. The Commonwealth and state taxes piece is a very common one that we come across, where I suppose the easiest creditor, and this has become less and less the case, but the easiest creditor not to pay is usually the ATO. Obviously, they've got a lot better at collecting their debts or ensuring that the level of debt that is accrued with them has become less and less. But it is still a case of where we see those sort of debts blowing out as a common indicator of insolvency. It's easier to pay the creditor that's going to cease your supply than it is paying for your Vass. Number 4, having poor relationships with your funder or inability to borrow further funds. This is a situation where you might see the bank calling in facilities or not granting an extension of further overdraft or that type of thing, not able to get additional working capital in relation to your business.
And typically what we normally see here as well is credit card debts running up and not being paid out. So and also lenders of last resort. So you're basically getting in a situation where you're borrowing money at 15 and 20% in order to keep the business funded.
That's a pretty good point there too, Jim. I always say to people, just because you can get access to that finance, it's a good time to be asking yourself the question as to what's your plan to get back out of it. If you are accessing that type of finance to save a business, then you want to ensure you've got a very strong exit plan to get back out of that finance. The next one being suppliers placing the company on COD or otherwise demanding special payment before resuming supply. This is just a common indicator that we see and we do look for as to when the company became insolvent, but it's an indicator for clients with their businesses to be saying, am I getting to a point where I've got depleted current capital? Inability to raise further equity capital. And this one we were talking about before, actually, around the concept that, Jim, did you want to explain to everyone the situation you were asking me?
Well, the equity capital would be, you might have a company that's in a position that its liquidity ratio is below 1, so therefore it owes more than what it's owed. It owes money to the tax office and the rest of it. Now, it's not necessarily insolvent if the directors of the company still have access to funds which they can actually lend to the business, to actually contribute capital to the business in order to help it through this liquidity crisis. Okay, so point 7 specifically, I suppose, refers to the point where you're sort of saying, well, if you've got a redraw facility on your home with a couple of $100,000 available on it, and that is available to should you decide to kick it into the business that's available to help fund the business, then that could be seen as the company isn't insolvent. Is that correct, Graeme?
Yeah, look, it is. It's a common piece that we see there, whereby you might have an insolvent company, but a director is continuing to fund the operations. The consideration is, and it's a common defence that a director would raise in relation to insolvent trading by a liquidator. The key piece is probably more around when and what action that director or shareholder takes in relation to those funding pieces. So hypothetically, you have somebody that is continuing to prop up a business and then says at some point in time, I'm no longer going to be contributing funds. That's a big sign, a big indicator. That should be a warning up on the board to say to the directors, well, as soon as you're put on notice of that, you would otherwise know that your reserves of equity capital have been depleted, and you're not in a position where continued trading will provide you with the protection of the corporate bail.
But even if you're in a situation where you're sort of saying, all right, well, look, I've still got $200,000 worth of equity in my home or a line of credit to my home, but I'm making the decision not to put any more in, then as a director of that business, if they haven't got, then effectively they've made the decision to cut off the capital or contributions or lend loans back to the business, any debt incurred from there on would then effectively be insolvent trading, wouldn't it?
Correct. Yes, that'd be right.
Okay, right.
That's a fairly high level way to look at it, but yes,
Okay.
you no longer have the defence as a director that I've continued to fund the operations, therefore the company is solvent. It's able to pay its debts as and when they're called due.
And there's plenty of situations that this actually occurs in real life where it's a husband or a wife that owns the business, and one of the spouses say, look, enough's enough. I don't want to put any more money into your business, and your business has got to stand up alone. So just because the funds are there doesn't necessarily mean that you're not trading insolvent, or you're not insolvent at that point in time.
No, exactly right. And one of the other things to consider is too, if clients are looking, especially say through current times where things might be tight, and they're looking at, okay, how do I get my business through from here to the end of a COVID period? I may need to introduce $100,000 or $200,000 worth of, say, equity capital. I'm prepared to do it and draw down on my house. There's definitely a piece there where, if some steps to be taken around putting into place proper loan documents, taking proper security over the business via a registered PPSR registration, and it's something that there's some very good lawyers around town and accountants like yourself, Jim, that can help guide their clients through how to do that, so that if they are putting in this capital, and again, when we say equity capital, if it is truly via equity, it's not as a secured claim. But if it is secured via those documents, then there's the ability there for that to be recovered in advance of other creditors if things don't work out, or at least provides a level of control in relation to the assets of the company if there is some form of distress at a later date.
So again, if we're going to put that into layman's terms, again, I always like to try to keep things a bit more simple. It helps me understand things.
No, of course.
If, as a director, I've lent my business $100,000, okay, if I have the correct loan documentation in place and I register that loan with a PPSR, okay, I am now a secured creditor of that company. As a secured creditor of that company, I actually have a say, and dependent upon what the debt the company owes me, if I'm the person that owes the company owes the most money to, then I would probably have a majority say in the creditors' meeting.
Combination of things. So, and again, this comes back to me being careful and saying I'm not providing legal advice. And
we're talking hypotheticals here.
Hypothetically, we're not looking at structuring the actual loan documents. But if you do get a proper general security agreement, it's called, and that's properly executed and properly registered on the PPSR within 20 business days, then subject to what that says, you might have a situation where a liquidator gets appointed and you could appoint a receiver over the top that is your controller that's in there to act for you to get your money back first. Without the receiver, you're still in a position where that liquidator has to account to you before the other creditors generally. There may be some overlap with employees in relation to the way the Act works, but you are in advance of, say, the ATO and some of these other creditors in relation to how the business is going to be or the assets are going to be dealt with.
Mm-hmm.
So it gives you control, and it gives you an advantage of an earlier and probably better return.
Okay. Now, one other thing that I wanted to touch on that, which you said within 21 days?
It's 20 business days that needs to be registered on the PPSR.
Now, is that from the first advance to the company or the last advance to the company?
So, again...
Or is that too technical?
If I remember correctly, it's from execution of the document, I believe, but the lawyers might correct me on that.
Okay, all right. Okay.
I think the piece being there, and probably the most important piece for any client is, before you go and advance the money, you get the advice.
Yeah.
Because at the end of the day, once you've advanced the money, it's difficult to put all the agreements into place.
But even if you've advanced it but the company is not in trouble, it's still a good time to do it. So as part of the housekeeping now, it could very well be a matter of saying, all right, well, look, we had an advance of $20,000. Let's get the loan documentation in place, even if it's dated now, and that $20,000 is going to be excluded from the loan. We've actually got something in place now to cover maybe the next $100,000 or $200,000 that we may have to kick into the business.
Correct.
So
yes.
There's just basically a bit of good housekeeping in order to make sure that you've got your business in a position, the most solid position to be able to protect your assets.
Yeah, that's right, definitely.
Okay. Sorry, mate, I'll stop interjecting and let you get on with your slides.
No, look, Jim, the point with all these things I always find is if we were to spend this time talking about some of these the topical stuff and not getting through the slides, the slides are just there to provoke conversation and discussion from my perspective. I'd rather answer questions.
Sure.
So creditors unpaid outside of trading terms, number 8. This can be a point where it always raises some interesting conversation when we've got people in the room or online that deal heavily in areas like construction and those types of things where they say creditors never pay inside trading terms, Graeme. That one's to think about in the ordinary course of a normal business in your industry, what is the norm? If the norm's 45 days and you've got creditors and you're paying creditors outside of, then that's one of those things to consider.
Thanks, Graeme. I might just jump in there. We have a question from Tony. Who would you contact for the certificate to be put in place for the advance loan?
Look, it is a legal document. It is what they call a general security agreement and a loan agreement. I think the best point of call is to contact your accountant that understands your business first. Someone like Michael or Jim there, and they'll be able to direct you to the right lawyers that you need to get that document in place correctly. The reason I say that is because they understand your business and the interworkings of all the other areas. And there's some very good lawyers around town that once they can get the instructions from yourself and from your accountant, they can put into place the right agreements in the right way so it interacts well with you.
Yeah, it comes down, Graeme, as well, knowing the right person to speak to. So yep. If you're going to speak to a solicitor who you've had dealings with for the last 20 years, but that solicitor predominantly focuses on conveyancing, so buying and selling the properties and stuff like that, and maybe doing wills, they may not have the correct expertise to draft the correct documentation. And all it's going to take is if you get to a point where there's a liquidator appointed or receiver appointed, they're going to be looking at that agreement. If they can find any holes in it, they'll find the holes in it, and it's pointless to figure out when you do need that document, it's not bulletproof. You want to make sure that when you're dealing with people, you deal with people with the correct expertise in that specific area to be able to achieve what you need to do.
Yeah, that's exactly right.
Great.
Okay.
Thank you, Tony. Hopefully that answered your question. And keep the questions coming, guys. Please type them into the Q&A as we go.
Thank you, Anna. I'll get through the rest fairly quickly and then get on to some other discussion points. So we're talking number 9, and this is a historical point from some of the cases about issuing post-dated checks and dishonoured checks. A good observation these days is how there's not a lot of checks flying around. Noticed the last few years that this is an area that has changed a lot, in that we're doing a lot more business by EFT, particularly during COVID. Even the processes for us as liquidators have changed a lot, where we used to had to issue dividends by check, and now it's EFT. So I think this area is one that will drop away. It's more being delayed payment or promises of payment that aren't occurring. Number 10 being special arrangements with selected creditors. So this is really where, and I hate to point this one out, but it's a common thing that we see, where payment arrangements with the ATO are one of the first indicators that we look at as a liquidator when I'm in that role, as an indicator of insolvency. Now, the arrangement itself says, okay, the customer, the client has gone and put a situation in place where they can restore solvency and they can pay as and when they fall due. But I caution everyone about putting that into place and then having any sort of issues where you default on that arrangement, because that can be a glaring indicator that the company can't pay its debts as and when it falls due. And then, look, if we look at some of the remaining indicators, these would be obvious, I think, to everyone. If we're in a situation where we're getting solicitors' letters, and not just one where you have a genuine dispute with somebody over whether you owe them money or not, but that you're getting these letters and summonses and then to the point of judgment with multiple other creditors that you have. Payments to creditors which are in round amounts or non-reconcilable specific invoices. Again, this is another one where, and not to give away what the investigation processes are of an insolvency practitioner, but the first thing that we'll do is look through the accounts and the bank statements of a company we're dealing with in liquidation. And we literally have the staff look for payment arrangements, recurring amounts, round sums which are not reconcilable. It is something that I would always advise, even if you are paying somebody off in a situation, pay the amounts per invoice. It is far less of an indicator that there is any sort of solvency issues with the company.
So what you're talking about, so if you've got a statement with 10 invoices on it, you're just going to be pay an invoice off at a time, as opposed to saying, I'll give you $500 per week or something. Yeah,
correct. That's that itself. Unless you're going to pay the full amount on the statement, I'd always advise to pay off the oldest invoice last, and in the same amount as what the invoice is. Yeah. So if it's 555, pay the 555, not the round amount. If you are going to go and make an arrangement to pay a specific invoice every week or something to that effect. It'll just make it harder for any liquidator that comes along to then try and say that that's a recoverable sum, or it indicates that you may have not been able to pay them as when they fell due.
Okay, so that's actually an interesting point you've just raised here, a recoverable sum.
Yeah.
Because this is now quite important when it comes to the creditor's perspective as well.
Yes.
So from that person actually receiving the money, so not only are we talking about now the situation where a business is paying round amounts to a supplier, you've mentioned the recoverable sum, which might mean, from my way of thinking, that if a liquidator were to come along, they might say, wait a second, that amount there needs to come back into it has to be paid back.
Yeah.
Okay. So we're now, this conversation is going to touch both sides of the fence here. So if you're in a position where you actually have a client that is looking at extending terms on what they owe you, don't accept round payments. Come to an agreement where you're going to be paying off invoices, specific invoices with the full amounts.
Yeah, that will. So what we're talking about here is preferential payments.
Yep.
If a company is insolvent, from that point on, a liquidator can look at then trying to recover payments that have been paid to a supplier in preference to others. Where we're talking about is if you're looking at collecting those amounts and want to be in a stronger position, receiving payments as per each invoice will give you a stronger position and a stronger case to say we weren't aware of the insolvency of the other company and the standard defences that you would need under the Act.
Okay, good point. That's a very interesting takeaway for everybody on that's listening in today.
The last one there is just looking at the inability to produce timely and accurate financial information. And this is just a little bit technical. If we're in a situation as a liquidator where a company hasn't maintained proper books and records and it can't point to the fact that it has done what is required under the Corporations Act of a company in maintaining its records, a liquidator can actually take action to say that the company has been insolvent from its inception or from any given point in time earlier when the records weren't maintained, and then pursue the directors for insolvent trading. I actually had a judgment, I think it was about 12 months ago, where I had a case just like this occur. Wasn't that the director, I think he just did it to try and avoid me investigating the background and the like, but he wasn't able to produce any records in relation to the company. We ended up with orders, I think it was in the federal court actually, in relation to judgments against him for the full amount of the creditors in that entity because he hadn't maintained proper records. So I was able to pursue him then personally for the full amount owing because he hadn't maintained those records.
Yeah. Well, look, I suppose in this day and age as well, I mean, since I've seen, like being around the accounting game for so many years, since the inception of GST 20 years ago, record keeping within businesses has improved dramatically. Okay, and particularly over the last 10 years with the implementation of the introduction of online accounting systems, there's really no excuse for actually not having accounting records that are up to date. We've got to be reporting on a quarterly basis to the tax office. We have obligations that we actually have to meet, statutory obligations we have to meet. So therefore, unless you've got your accounting system up to date, how are you going to possibly make a decision on what the business is doing?
Yes, exactly right. Exactly right.
Just cutting in there, guys. Jim said that, there's no excuse for not having your records up to date, but as much as I think most of our client base, and there's never 100%, but most of our client base is totally up to date because we do that. We know there's a lot of businesses out there, particularly we know that because we get new clients and we look at what's going on in their bookkeeping and how their accounts are held, whereby they have information that is totally inaccurate. And I go back to that taking control of your business. If you don't really know your numbers, how can you have control of it? Do you see that, Graeme, in some of the businesses that come to you that you just can't even see what's out there until it's cleaned up?
Yes, it is a common occurrence in businesses that end up in the hands of a liquidator, Michael, is that even the ones that do maintain records don't look at those records or are receiving them in such a historical fashion that they're not making decisions based on the information that's in front of them.
Yep.
Even the initial conversations that we do have with a lot of people is very indicative of the fact that there's two ways to look at it. You prepare records for compliance, or you prepare records to be informed about your business. Most of the businesses we deal with prepare records the businesses that we deal with that end up in liquidation and ultimate failure prepare businesses records for compliance.
Yeah.
The people that come,
and typically they're skewed for the compliance that they want to show.
Yeah, exactly right.
But you know, the reality is though as well that there's a lot of business owners out there that have engaged an accountant, and if your reality is in the business owner's defense, if you're actually paying somebody to do something for you, you're assuming that they know how to do what you're paying them to do in a competent fashion. Okay, and the unfortunate thing about it is there are a lot of incompetent people out there that call themselves accountants that may actually create a problem for the client, and the client's totally unaware of the situation because they know less than what the accountant knows. And this is where I think there is a problem, and if the government was actually going to do anything about a cleaning up the accounting industry would be a great thing.
Yeah, couldn't hurt. Definitely.
No.
Definitely. So they're both indicators of insolvency. Jim, I don't think there's much utility in dealing with that.
Yeah. Here's some numbers. Here's what we look at. Okay, so don't get totally baffled with this, but fairly important to know that here's what's available to you. In this example here, there's $389,000 available, but there's $566,000 owing in the short term. Now that's got to be ringing alarm bells to say, well, what are we doing here? I think that's probably enough on that side, don't you reckon, Graeme?
Exactly right.
And isn't that a great example of a report that's designed to run your business, not compliance?
Yeah, it is. And it's one of those ones where if you were to just look at the money in the bank or the debtors that you have and say, hey, I got the comfort of having $300 and something thousand worth of money coming in. It misses the fact that you've got all these current liabilities or accruals and things that you haven't otherwise dealt with. So
one of the things as well that you got to point out, though, you might actually still be strong on your assets and liabilities, but it's actually critical to know that if one of your largest assets is money owing to the business from your customers, you've got to be on that like a dog on a bone, because you want to make sure that just because your balance sheet looks healthy, you don't know what your customer's balance sheet looks like, and you don't want a few customers falling over. You figure out you're not going to get that money, and then you're put in that position as well because there's that liquidity or the money that you're actually expecting to come in doesn't.
Right. How many people are owed money by Virgin? Whether it's a cleaning company or whatever, that when I've got a good customer and they might owe me 200 grand, but that's a common turn in a month or two with that entity. That could be 200 out of the 300 that we were looking at on that balance sheet, and all of a sudden the sort of 0.7 liquidity ratio dives down to 0.2.
Yeah.
We very regularly see that sort of occurrence where the failure of the entity is because they've lost a large customer or somebody else has fallen over.
Well, I actually had a client quite a while ago when Darling Harbour was getting built. They were one of the main contractors working on Darling Harbour, and they had severe liquidity problems because back in those days it was called the Department of Public Works, was making redundancies in staffing. So he put progress claims in, and every time he went in there, that person that he dealt with the last time wasn't there any longer, and he'd had to go for the same story. And his major part of his liquidity arose from a state government department being so inept not being able to pay him. It's an issue, but at the end of the day, he was actually, the tax office went after him as being insolvent. Even though it can be shown that it was a state government that owed him money. But so this is where you've got to be careful. You might actually have a solid business and you're invoicing and you're preparing work and the rest of it, but if some of your clients are delaying payments or they do fall over, it can actually change that like very, very quickly can turn the situation around to where you've actually got to be watching as a business owner what your position is and what you're doing.
Yeah. And it comes back to that comment that Mike had earlier about being in absolute control. It's monitoring your business, and I think the old saying is working on the business rather than getting caught up working in the business.
Yep.
Having that focus on, and through the financials and the records and real-time information, having that focus on where we are and where we're going. And in the current climate, that's more important now than ever.
Absolutely, in the current climate, because things change so dramatically, and you know, depending what industry you're in, under current circumstances, it can be swinging one way or the other.
Yeah.
To the point where it swings so much in your favour, and there's so much work that you might run out of capital.
Yeah, exactly right. Exactly.
You might, you know, because you're trying to do too much, and you're just so busy, you've lost control. And all of a sudden, you're owed money, you're going really well, you think you're going really well, but hang on a minute, you're not getting paid.
That's yeah, you might find too, like you're saying, that because you have got so much work, it's locked up in debtors, it's not converting to cash, but you have to pay expenses. We do see businesses stumble and fall because they don't have the money to pay for the wages that they're incurring on employees that they're then getting back in
60
months,
days.
2 months to 3 months time. I'll pay you 30 days after invoice at end of month. People think I'm getting paid in 30 days and it's 60.
And this is where it's absolutely critical for any business, regardless of the size. You've got any business that has got limited resourcing or limited funding. Okay, I mean, if you've got $10 million sitting in the bank, a cash flow forecast, if you're running a $1 million turnover business, is not going to make a difference for you, because you're always going to have reserves there. But
well, that's what Virgin thought, Jim.
Yeah, but most businesses actually do have the need to actually be able to sort of say, all right, well, I know that I'm getting paid in 60 days, but I'm still funding wages on a weekly or a fortnightly basis, and I'm going to be funding the PAYG withheld on a quarterly basis. And how's that going to actually, as a cash flow position, how does my business look like? Because it should be fairly easy for somebody to be able to, once they've done this exercise, say, well, in March next year, I'm going to have a problem and I'm going to need $50,000 of additional capital. It's far easier to address it 6 months out rather than waiting till you've got the problem.
Yeah, very true.
Okay, so it's not only about maintaining good records, it's also about actually doing a bit of planning within the business to actually have a backup plan for when things, so you don't get surprises for something that you should have been able to foresee.
Well, Jim, I go to that, you know, we've codified the 5-step process. So, you know, if you've gone through that and you've done it, and, you know, you've got a grip on your profit and loss, you've got a grip on your debtors, your creditors, and all of those things, you know, your financials are up to date, you've done a bit of work around your business blueprint, and things are not going quite as well,
you can plan it.
It's a lot easier to sort of dive in and say, okay, well, what's going wrong, and focus on, you know, the things that are going to matter the most. Then they come in, they go, I've got no money, and what are your debtors? I don't know.
Yeah, 100%. I was speaking from the same playbook here, Paul.
Yes, and so that's about taking control.
Yeah,
you know.
Yeah, very true.
So financial statement analysis.
I think what we might do, Jim, seeing we've got about 5 or 10 minutes left at the most, let's jump down to the slide 10 with the COVID concerns. I mean, most of this stuff that is in the other slides is fairly either self-explanatory or it's the ordinary world type of thing. But one of the key points that I wanted to highlight is some of the changes that we're experiencing now, the effects of COVID, but also the stimulus that's happening to businesses. And it's what you've touched on there before. Some areas have been in decline, but some have really taken off.
Yeah.
one of the key motivators, if you go back to the start, and I know this only because I had to write a paper on it a couple of weeks ago, was where the JobKeeper came from. And some of those initial larger businesses that were advocating that they were going to fall over if JobKeeper didn't come in, have actually returned and posted super profits and no longer qualify for JobKeeper, because whilst their retail stores were closed and their overheads have declined significantly, their online sales have gone through the roof. You've had a lot of people sitting here working from home who, like probably a lot of us are sitting here in a home office or the like. I didn't have to pay travel. I didn't have to pay for my lunch today from a takeaway outlet. You know, I haven't got other costs that go along with going to work. So I've got a bit of extra dispensable income. What do? I shop online and buy bits and pieces that probably wouldn't otherwise buy.
Yeah, it comes from spending so much time at home as well. There's been a lot of, like Bunnings has been recording record profits as well, because there's a lot of people spending so much time at home. They're sort of saying, well, I'll do this while I'm here, I'm doing that, because all of that time spent at home is actually highlighted what they need to be doing.
It's also, sorry.
Not to mention all the packages from Australia Post.
Yeah.
Not to mention the electricians that come out to your place to hard data wire so that you can, get a quality Zoom going, like I did. And I had extreme difficulty finding an electrician that had the time to come out and do that.
Yeah.
And a quality headset, Michael.
Yes, that was another story.
Yeah.
That was funny. I'll digress a little bit. I went out looking for a headset for our receptionist, who at that stage was working out of the bedroom from home. And I couldn't find any. Went to 3 stores, but I ended up in JB Hi-Fi, and I bought a 75-inch TV.
Right, okay. That made sense.
Yeah, absolute sense. But, it was a bargain and I was there. And I thought, that'd be good for home. So, crazy world of COVID.
Yeah. Totally forgot about your headset requirements.
Yeah.
Jim had to actually share his because we couldn't find one.
Yeah. But going on though, so there's some issues coming up. I think what we're trying to, the general crux of what we're talking about here is the fact that a lot of businesses, and I know that from our personal experience with dealing with our clients within our business, a lot of businesses qualified for JobKeeper in April, in the month of April. Okay. Yep. If we're going to be measuring the June quarter on June quarter from the previous year, they may not qualify. Okay, and that's not to say that they haven't actually had a decline in business. They may have had a 20-25% decline in business. And that's still a significant decline in business. But come September, the end of this month, we're actually going to be looking at measuring how did we go this September against last September. And whilst things might definitely be slow for the majority of businesses, if they don't hit that 30%, then the 30% decline, the rug has been pulled out from their feet. They haven't got now the JobKeeper, which effectively has supported a lot of businesses. Many businesses have said, we have never been, like our cash balance has never been so healthy. In the interim, they've been accumulating ATO debt because they're basically saying, well, we're holding on our cash for reserves. They've been having wages subsidised and all of this coming out and mortgage repayments put on hold and everything else. Now, we're going to be in a situation, I think, now where now more than ever, like in the 26 years of us being in business, I don't think that I've ever seen or going into a period which is so critical for businesses to be actually on top of what they're doing now and actually having a plan B and maybe even a plan C, because this isn't just going to blow over. Today on the news it was officially reported that we are officially in recession now as well.
Yeah.
So,
well, you've got a situation, Jim, where you've got like the 3 bottom points there, or 4 even, the hidden accruals, like you're saying, you've got withholdings and super and all that type of thing that JobKeeper's coming through for, but it's going to have to be paid later down the track. Yeah, so you do need to have those cash reserves there. We're paying this stuff by way of wages and getting it back in our JobKeeper. But when all that dries up, and then you've got, at the moment, all the funders have been encouraged to fund.
Yeah.
To lower the policies around funding, to get this 250 grand loans out that they were endorsing, and to play nice in the marketplace. What happens when that stops? These aren't the types of people that just give away money for no reason. They want it back. I've already seen a couple of businesses that have got that 200 odd low business loan and have blown it. You've got the situations around the statutory demand process whereby we're still to see whether this is going to be extended or not, but at the moment it would take 6 months for you to have the timing on a stat demand expire. So when you want to collect your debts by somebody that's in some financial trouble, they just look at you and say, we're not going to pay. So I think we're looking at a scenario where, I don't want to be the Grim Reaper in the room, but things are going to get worse before they get better. We've had a situation from our side of things where the number of formal appointments coming through of what would normally be business failures outside of COVID is down nearly 70%. So there's a lot of these businesses out there on JobKeeper that are effectively getting adrenaline shots in the arm to keep them alive.
On life support. Yeah.
Yeah. They're not going to come back out of this coma, but they'll still be racking up debts with good customers that have the risk of taking them over the edge as well. So now more than ever, I think it's back to what Mike was saying: absolute control, close monitoring, being aware of what our businesses are.
Yeah.
Yeah. I might just jump in there, and a question for Jim as we're approaching time. Jim, at what stage should people engage with Graeme?
Look, it's going to have to be. Having Graeme. Graeme's one of these guys that we've known each other for 15 to 17 years or something like that. So the stage would be when we actually sit down and have a chat and say, look, this is looking bleak, and we do actually need to have a conversation with Graeme, because it's better off if we're the instigators of anything that's going to happen, as opposed to waiting for somebody to instigate. Okay, so I'd always be recommending that you need to be speaking to your accountant and be guided by your accountant. And we always, Graeme's always very open to coming down and lending an ear as well, and actually giving his own opinion on the situation. And we've always found him, Graeme, to be, well, that's why we always work with Graeme, because we've always found him to be very, very fair and supportive. Like, his aim is not to liquidate, his aim is to try to, if at all possible, and he can come up where we can put our heads together, we can come up with something, a strategy that's going to save the business or save the client a lot of heartache, we'll do it with our heads together.
Mm. Yeah, and I think we've seen that in the 13 signs of insolvency today. That was really fascinating and very, very detailed.
Yeah. Well, I actually think...
Sorry.
I
was going to jump in there and say, you know, the recurring theme about taking control. So if you're in early, you can control the process yourself. You've got much more opportunity. And I was going to also say, you know, there's a lot of concerns that some people have about insolvency, the process, the stigma, and they're not real. Nobody likes to say my business failed, but if you can get in early, then, and you know, maybe Graeme should talk about this a little. If you can get in early, you can avoid that, even if things are that bad.
Yeah, a restructure.
A restructure.
Yeah, you see, how many businesses did you hear that we didn't go and they weren't insolvent because it's a restructure?
Yep.
And that's the key theme that we try to get across to everyone, Mike, is that the earlier that we can sit down and talk with anyone, the advisors and the clients, in relation to the position that they're in, the more options that we've got that we can recommend, the more different opportunities there are to deal with the issues that are on the table. Late intervention, there's probably a lot of the time only one solution, where I'm saying the company needs to go into liquidation to potentially protect personal assets and things like that. Whereas early on in the piece, it can be as simple as, here's a few steps you might want to take and work with your accountant to affect them, and I go back to my office and get back on with what I was doing otherwise. It ranges from all of those types of things, and it's the earlier we can have the conversations to point out the right path to everyone, the better.
Yeah, and that really comes down to, again, what Mike was talking about. It's actually taking control. Start acting early, and acting early is actually having a plan, knowing where the business should be going, so you can identify when it's not going in that direction, and you know if it's not going in that direction what the repercussions may be, because that might be 3 months out before those repercussions actually occur, and it's good to actually have a plan to be able to avoid that.
That's right.
Wonderful. And that's, I think, the 5-step process and the 13 signs really works in well together. That's, I can see how it all ties in. Sonia's actually asking if she can have the slide with the 13 signs and the COVID slide for the website, which I guess we'll follow up later. Jim, did you want to put the poll out there now?
Sure.
Wrap up.
So I'm going to stop sharing now. Okay, so I've got everything back here. So we're going to start the poll. So it'd be really appreciated if we can get a bit of feedback on the poll, and hopefully everything that we discuss is going to be of some use and benefit to our audience. And certainly also keep in mind that we're here to help. It's not going to, there's no embarrassment in saying, hey, look, I think I'm in trouble. It's probably better off to be able to sort of say, all right, well, I know who I've got to speak to. And it's not to say that we might have 100% of the answers, but certainly we've been around the traps long enough to be able to know who can actually help with a specific problem. So as our good friend Graeme here has made himself available to us, it's normal, it's part of our normal business to actually try to help each other out, see each other's clients, and where we can actually add a bit of value to help each other, we'll do that.
I'd just like to add, you know, if you're sick, you go to the doctor. So, you know, physical health, financial health, you don't leave it till it's too late. And just personal thank you, Graeme.
Yeah, mate, I really appreciate your time. And thank you, Anna. You've done a fantastic job as well.
Thank you. Thank you, Graeme. That was absolutely fascinating. I had no idea there were so many signs of insolvency.
No troubles at all. Glad to be here.
Really amazing. And I think that point that Jim and Michael just made is a reminder for everyone. Perhaps it's not your business, perhaps it's a business owner that you know who could benefit, and ATB are here to help. So please reach out to them, refer a business owner that you know, and you can see that they're absolute thought leaders in the industry and leading the way here.
Yeah. Well, the whole idea, it's the point I've made is we want to try to help people. I mean, ultimately, Australia, or the whole economy, the world economy is heading towards a cliff very, very quickly. Okay, so it's fairly important that everybody can help each other, and it doesn't necessarily mean to say, well, my business is fine, so therefore the world is a pretty place. Within our own circles, we might have family, friends, we might have other businesses that we deal with in the course of our own business, that we can actually identify that maybe having some issues. And there's nothing wrong to actually extending a helping hand to say, look, do you need help? What can I help you with? Do you need an introduction to somebody or whatever it is? Because it's important that if we're all going to get through it, we're all going to get through it by actually looking out for one another, as opposed to sort of concentrating on what our own patch is and not really concerning ourselves about the greater community.
Totally agree, Jim.
Absolutely. And mental health during this period is more important than ever.
Absolutely. Absolutely. The point I'd like to make, going back to control, if the feeling when you just haven't got a grip on what's going on in your business is horrible, if you're in control, it might be bad, but at least you're in control of what's going on. You know the circumstances. It's a bit like, you know, when people don't know what their health is, and you know, your mind speculates. You know, I've got cancer, I've got this, I've got that. When you know what it is, you then know how to deal with it because you're in control of it.
Yeah.
Yeah. So get the diagnosis from the experts.
Yep.
Yes.
Okay, so could I ask, we're about 66% of the way through our voting. We could waffle on all day, but I suppose if people want to get back.
Participants are still here. They're enjoying it.
We waffle well.
Is there any, did anybody have any questions they'd like to ask whilst we're waiting for the polls to be completed? No?
Feel free to jump in.
I think
Okay,
we've
cool.
stunned them into silence, Jim.
I think everyone's just absorbing that amazing information.
Yep.
Either that or we might just have to play a loud noise to wake people up.
Yes, that's it.
All right, guys. Well, I think we've got all the votes that we're going to get voted. 75% voting. So, thank you very much, Graeme. Again, thank you very much for your time. It's been very much appreciated and great topic to cover.
No troubles. Thank you all.
Thanks, guys. Take care.
Thanks, Jim.
Bye-bye, everybody.
Michael.
Bye-bye.
Thanks, Anna. Bye.
See you on the next webinar.
See you on the next webinar.
Take care. Bye.